Hello, and welcome to the latest episode of the Wealth Management Invest podcast. I'm your host, David Bodamer, the editorial director with wealthmanagement.com. I focus on investments coverage. And this week we have with us Tom Cohn, who's partner and chief solutions officer at Cerity Partners. Tom, welcome to the show.
Thanks so much for having me, David. Really happy to be here.
So before I start throwing some questions at you, just wanted to give you an opportunity to talk maybe a little bit more about yourself and your background and about Cerity.
Great. Tom Cohn. I am the Chief Solutions Officer at Cerity Partners. Been here almost 9.5 years now. And in my role, I oversee all our central services, including our investment organization, which includes private market investing that we're going to get into here in a minute.
Yeah, so good segue. Private markets are obviously a very, very hot topic in our industry. There are a ton of asset managers who are constantly doing some innovation, rolling out some new products, trying to get you to buy them or get them in front of your clients. So, before we kind of just get into some of the strategies, I just wanted, from your perspective, when you're talking about private markets, what does that mean for Cerity, and what are, what's your overall a framework for looking at that at the asset class?
That's a really good question because I think prior to a couple of years ago when we talked about private markets, you would have heard words like alternatives, a broad catch-all for a number of strategies that aren't cash, fixed income, or equities. But when we talk about private markets, we truly mean assets that live in the private markets that are hard to access. And the way that we think about it at Cerity Partners is in the four following buckets. We think about private equity, so companies that are private in a variety of strategies, venture capital, which again, private companies, but in earlier stage form, and then private credit or private debt, and finally, real assets that encompasses real estate in a private form, infrastructure, and a variety of other types of assets that maybe don't fit into equity or debt.
Okay. And so you're looking across the whole universe of private markets. And how primarily are you thinking, do you look at accessing those? Because there's also a lot of talk these days about, for years, it was pretty much just drawdown vehicles, their traditional drawdown vehicles. Now we've had all this innovation in, whether you want to call it evergreen or limited liquidity or semi-liquid. There's a lot of terms that folks have that I think basically are talking about the same thing. When you're looking at it, are you looking at also both the traditional structures and these newer structures?
We do. We look at both, as you said, and we break the universe into what I would call more of a traditional drawdown structure where you're committing, but not necessarily investing that capital up front. And the newer innovation in evergreen structures where usually all the capital is called up front. And it really depends upon the asset class. So some asset classes lend themselves better to an evergreen structure. Private credit might be a good example of that, where other asset classes like venture capital may be more appropriate in a traditional LP or drawdown structure. And then it's going to be very client dependent. So clients that have much more ability to take on illiquidity risk, that can have a higher allocation into the private markets. Drawdown structures could be more appropriate for the vast majority of their exposure, like we've seen for the last 30 years in private market investing. And for other clients that maybe can't take on as much illiquidity, a simpler structure may be more appropriate to get the right level of diversification within the private markets.
Yeah, that was going to be kind of my next question, which was when you're looking at your client base, can you talk a bit about who primarily are, what is the profile of your clients? And when you're thinking about private markets, is that something that you think about at this point for all clients, or is it more of still just like a subset that's really thinking about adding this to their portfolios?
Yeah, so we have three primary client types: individuals and family, mostly ultra high net worth to high net worth clients that we're servicing, corporations, and then institutional investors like in endowments and foundations. And we'll think a lot about, the following. One, how much can you tolerate, or how much can you allocate into an asset class or asset classes that are illiquid by nature? And you may not be able to get liquidity for 3, 5, upwards of 10 years. Second is the complexity of the investment. And we want to make sure that every investor that goes into a private market vehicle, whether that's an evergreen structure or a drawdown structure, understands the basic concepts behind one, the terms. Can I get quarterly liquidity?
Mm-hmm.
When may that quarterly liquidity not be available? Because it's not a guarantee of liquidity. And two, do I understand the strategy and the underlying assets and why they may be illiquid? And so those discussions on a client by client basis will really inform, one, what is the appropriate amount of private markets exposure to be additive relative to their private markets allocation? And two, how do we go and build that with individual strategies and individual structures that we make sure that we're taking into account an individual client's liquidity preferences and tolerance?
And is there typically, what do private markets add to a portfolio at this stage? Is it primarily, I mean, I'm going to guess it probably depends a little bit on the asset and the client. As for, that's always the caveat, as much as we can talk in broad terms, that's always helpful. But is it primarily income? Is it diversification? Is it something that's being driven by macro considerations at this point, like, higher correlation between bonds and equities that maybe we've seen historically? So privates maybe add this diversification that maybe a certain clients are looking for. What are the goals what are some of the top goals that you're trying to achieve when considering private markets?
Yeah. So I think one, you have to take a structural view or strategic view that you want to allocate to private markets. Unlike public equities or fixed income, there's not an ability to get out of these assets or strategies within a day, a month, even a year. And so you really have to have a long-term commitment. The portfolios we build for clients are with usually decades in mind. And so really trying to think about long-term, what is going to be additive, and then how much of that individual investment can be additive without taking undue risk to a client portfolio. So, those are the considerations when we think about how do we add it. Now, what are the benefits of private markets? Going back to those 4 asset classes, each one's a little bit different. Mm-hmm. Private equity and venture capital, we would look at return enhancements. We want to be able to deliver over the long term, hopefully an expected return above and beyond what you could get in the public markets. In the case of private credit, which you referenced, looking at income generation, again, above and beyond perhaps what you could get in the public markets. In the case of real assets, there can be an inflation or diversification benefit to owning assets and infrastructure or real estate that may benefit a portfolio in times when either fixed income or equities aren't working. I would say the underlying reason which we're excited and think about the expanded opportunity set within the private markets is just much more of the global economy lives and sits in private markets today than 5, 10, 20 years ago. And there are a couple of reasons for that. One, you have less companies going public, right? And just the sheer number of public companies, as a percentage of all overall companies being less than it was 20 or 30 years ago. Second trend is you have more private companies staying private for longer. So the conventional wisdom was, hey, the largest companies are ultimately going to be public. That's not necessarily true anymore. And we have companies that are worth well north of $100 billion staying private. And because of the access to capital that you can now get in various forms of the private markets, companies have that optionality. So what does that do for an investor? Well, an investor not allocated into the private markets is missing out on potentially really interesting parts of the U.S. and the global economy. This could be in the healthcare sector. This could be in the technology sector and what's going on in artificial intelligence. This could be in the private credit sector. This could be in infrastructure around data centers. And that enhanced or expanded opportunity set, we look at as one of the key benefits of having an allocation into the private markets for our clients.
Yeah, that's a really important point. And just this, if you want to be a really thoughtful investor and think about all the opportunities, just like, the private universe, it's just a different dynamic as opposed to the past where maybe a company might have been private for a growth stage and then look to exit in the public markets, that's not necessarily the case anymore, right? That's what you said, that people can stay private for longer, for bigger. They have access to some of this. I mean, it also sounds like the private capital and private equity, or private credit and private equity go hand in hand in some ways, that the growth of private credit is helping facilitate the private equity and private real estate be just not have to think about going to the public markets for at some point.
It's absolutely true. I'll use the example of, if you were an investor 30 years ago, you may have thought about just stocks within the U.S. in the U.S. market. And a way to expand diversification or the opportunity set was to invest internationally. Now, 30 years ago was a little bit harder before the advent of ETFs or the expansion of mutual funds or separately managed accounts to be able to get that exposure. But over time, most investors and most wealth management firms have accepted there's a benefit to global diversification when it comes to traditional asset classes. I think the concept can now apply to the private markets. There are more and more companies, and substantial companies, that are private and accessing either their equity exposure or their credit or their debt exposure is a way to enhance or expand the opportunity set, no differently than 30 years ago it was global investing.
And aside from this kind of like really macro picture on like that you've laid out around just the overall state of private markets, are there other like themes within the economy or just macro themes that you're looking at that are driving stories in any of these particular asset classes? Like, we've talked about the four big buckets. I don't know if there's like one or more that you want to kind of hone in on. Like, is there an interesting private real estate angle that's being developing, or something around private credit, or, anything that you're seeing around some of these, food groups?
Yeah, we would define it as kind of three major, and these are broad-based themes that drive a lot of our long-term investment decisions and allocating capital to private markets. The first is just the expansion of private markets. When we look at some of the studies by McKinsey or BCG or Preqin, we just see private markets continuing to increase and the assets under management growing by 2030 or and beyond at a higher rate than what we're seeing in the public markets. Second piece of that is you have a lower allocation within individual clients relative to institutions like endowments, foundations, pension funds, and that's increasing the need for really great solutions for those clients. And so there are a variety of ways to play that theme. GP secondaries is a good example. GP stakes, where you're actually sitting side by side along a general partner, are key themes we've invested in and think a lot about. The second theme is generally around this innovation cycle that we're seeing. And this is happening in a couple industries. I touched on a little bit on technology and healthcare. We think there's a massive impact. Clearly, just the enormous amount of capital that's being put to work to support the acceleration of AI and the infrastructure that's required is a really good theme. So it's not just the companies themselves that are going to be the beneficiaries, but the need to build these really massive data centers to be able to support that innovation and that growth is really critical. So that's our second theme. And then the third theme is really the shifting out of the banking sector into asset management of credit. And this is something that happened after the global financial crisis in 2008, 2009, where we saw a shifting of risk from banks to asset managers. The first wave of this we've seen in direct lending, which has really been a shift in a growth. You referenced the need to support private equity through lending strategies. We're now seeing that in asset-backed lending, which is a big push that's coming out of the banking sector. And so we like all three of those themes as a way to really think about broad-based exposure into the private markets.
And you mentioned a couple of things that are up and coming that I think maybe folks maybe not even understand what they are. So like secondaries, first of all, can you just like draw out a little bit more what you mean? That's both. I think there's even a couple of flavors of secondaries when we talk about that, right?
Yeah, it's a great point. So you can make an upfront investment into a private equity or a private debt fund, but then because of the need to get liquidity, whether you're an institution or an individual over time, there is a market that exists to be able to get liquidity. The challenge is you usually have to, pay a price for that, or there's a discount to be able to sell shares into a secondary market. And so over time, you've had managers and firms that have developed a strategy to go after secondary opportunities. And because you have more and more capital and more types of investors in the market, that secondary market is expanding. And we like a lot of those strategies because, one, you can get diversification.
Mm-hmm.
Two, you're more fully invested up front than at what we would call a primary or an initial investment. And we only see those opportunities within the secondary space increasing as more and more entrants come in to be limited partners or investors into private markets.
And I could see it from like an investor perspective, getting access to secondaries, it could provide you diversification, both just in terms of like the number of deals that you're getting exposure to, but also like a vintage diversification, right? By like having some exposure to so older deals. So if you're getting a private equity exposure, you're not just getting like new stuff. You can get stuff that's a little bit more seasoned, and then have like a nice blended, potentially nice blended exposure in a lot of ways by mixing in secondaries. Is that accurate?
That's exactly right. One of the challenges that I think has led to a lot of the solutions coming in the market is you just don't want to commit to a single fund and say, well, this is a great fund, this is a great manager, I'm gonna bet everything on this single vintage, as you said. And there are a lot of things when you make an investment into a particular year that can go wrong, right? And we look at this throughout history. When we look at private equity back to the 90s or 2000s, there are good years, there's okay years, there's bad years.
Mm-hmm.
What you want to do is be with really high quality managers, but spread that vintage risk. So you don't want to put all your eggs in one basket, invest in 2025 or 2026. You want to spread or blend that investment over time. And as you pointed out, secondaries can be a great way of buying a basket of underlying companies that came into a portfolio over a number of years.
Right. And another theme that you talked about is this AI, and the data center thing. I find that interesting. But one of the things I find interesting about that is that, maybe like 5 years ago, data centers was kind of just seen as like a real estate asset, partly because of it was just kind of a box that had some servers in it, and there wasn't that much operational expertise, or there wasn't some of the power requirements. Now, when you're talking about the AI, the data centers for AI, it's a totally different beast. And I hear these talked about more as like an infrastructure play, because it's got, there's an operational complexity, the size, the power components to it. And all of that means that like you would need really top, the potential people that could be building it kind of narrows, right? Like, you need to like actually find somebody who can build, operate, manage this thing. And so that creates very interesting selective investment opportunities. That's at least kind of the way that I like think about it, as opposed to just like, what somebody said when they meant what somebody meant when they said data center a few years ago.
Well, I think data center has taken on a whole different meaning with the AI boom and just the increased need for that, given the computing power that's required to run, manage, and ultimately improve these models, which are shaping our everyday lives. And there are two ways to approach it. One is to, invest in those companies that are on the innovative forefront of artificial intelligence. And whether it's driving general use cases of the technology or very specific use cases to an industry, that's one interesting way to play the AI boom. And we're looking at that in traditional, what I would call private equity, venture capital investing. The other way is through the infrastructure, the proverbial picks and shovels, right? That's required to actually maintain and grow that. A good example would be to get the internet boom and ultimately the social media boom that we saw in the 2000s and 2010s required a lot of fiber optic cables to be laid at the end of the tech bubble, right? That was the infrastructure that ultimately supported this change in the way that we consume media and information. that is the data centers of today, which ultimately support all the computing power that leads to these great innovations for businesses and consumers. And we like that, and we've made investments there as a way to support that.
So we're touching on I think what's interesting about private markets is that it immediately gets to be very complex, because you're talking about a lot of different asset types, a lot of different structures, a lot of different managers potentially. So what is your process in terms of just due diligence, keeping on top of trends, really thinking about how to and then communicating, basically being able to distill and communicate the stuff back to clients. So kind of more from a practice management perspective, how do you approach all this?
It's a really good question. So I'll answer it from two angles. One, we've got a really experienced, robust investment team that does all the research. So in any given day, they're looking at multiple managers over the course of a year, looking at thousands of potential investments across private equity, venture capital, real assets, and private credit. We have roughly 16 people devoted to that effort. That is their main function, thinking about who is the best manager, what are the best sub-asset classes or strategies. You're right, though, that's a ton of information. And while the team loves to get in the weeds, from a client perspective, it comes back to asset allocation. Mm-hmm. And so we start with clients not, hey, here's a really interesting strategy. This is why you should be interested in it. We're building portfolios for the long run. Mm-hmm. So it starts from, you should have this much allocated into private markets. We feel it would be beneficial to meet your goals and needs. Okay, great. We agree on a number. And then how do we allocate a portion of that to private equity, venture capital, private credit, and real assets? And then those strategies or those sub-strategies that we touched on, like GP secondaries or GP stakes, will be used to fill the buckets. Mm-hmm. But the really important part is that high-level strategic asset allocation and having a client understand the trade-offs, the illiquidity that comes with investing in the private markets. Those are the two critical paths, to really get buy-in from clients. Because if you get into the weeds, you can get lost on a particular investment, a particular mm-hmm. strategy, when really the goal is that strategic asset allocation.
And what are, again, obviously it's going to be client dependent, goal dependent, but is there a general range at this point around what percentage of portfolios may include private assets at this point?
Yeah. So for clients that have the appropriate level of tolerance for private markets, have the experience in that, allocations can look much like what we would see in institutional portfolios mm-hmm. of 20 to 30%. For other clients that don't have the ability to take as much illiquidity risk, that can look something like 10%. It really is going to, as your point, depend upon the client and their situation.
Right. It's always got to start with what their goals, what their situation, so there's no one size fits all. I think that's always an important caveat. As much as we like to, as much as I, as a journalist like to talk and, it's nice to have a clean number, but I always like to acknowledge the reality that obviously this is always client specific, always got to be goal specific.
Yeah. You think about a client that comes into us and has made, their money in the real estate mm-hmm. Industry, and has a lot of outside assets tied up in industrial properties or residential properties. We're going to tailor that portfolio to have less real asset exposure because they already have that in the portfolio that we don't manage. Contrast that with a private equity executive who comes to us and has much of their wealth tied up in the carried interest or interest in their firm. We're probably not going to have as much in private equity as we may have in real assets or private credit.
So in that case, is it taking a concentrated position and helping diversify, or is it just helping to add on to what they might have? So just give them this more diversified private markets bucket.
I mean, the goal in private markets is always to be diversified. We don't want to take a concentrated bet in what we're managing. We want to diversify across strategies, managers, and vintage. And so it would really depend upon the client, but it's to provide that broad exposure, but taking into account their entire net worth. And that's really where you get a lot of the differences in client portfolios. It's going to come from the client's specific situation mm-hmm. or their ability to take risk. And that's where the different structures that we talked about at the beginning come into
Mm-hmm.
play. Certain structures can be better or more suited for certain clients.
Right. Yeah, there's some of these evergreen stuff which, have a little bit of a liquidity mechanism, or like I think a lot of the folks who do some of the private equity stuff, it's like it's not a J curve when you come into the evergreen, because you're fully invested from day one, and you don't have to have this go through the whole life cycle necessarily. It's like there's factors like that which I've heard mentioned.
Certainly, the benefits of those evergreen structures are generally you have capital called up front, so you're invested day one, as opposed to, it could be a number of years in a drawdown structure to be invested. Second piece is you have potentially the ability to get liquidity, although that's not a guarantee. It's subject to a number of constraints or terms. And the third piece can be that the taxes are simpler. You're not generating a K1, right, which can be complicated. And for a client investor who's never had a K1, that can be a little bit of a difference. And so it's really important to understand those nuances. And that's what will drive a lot of the decision around an evergreen structure versus a drawdown structure.
So I've been bouncing around a bit. I appreciate you kind of just rolling with the punches and going with me, but I appreciate all your answers to my questions here. Is there, just as I've been talking to you for a good chunk of time, so I want to be mindful of that too. Are there any things that I have not asked, or are there any particular themes that we haven't touched on that you want to address before we kind of wrap up?
I mean, the one that we've touched a little bit with data centers, but I would say just the general interest in infrastructure, particularly with the movement to think about onshoring and tariffs. And while you don't want to make any short-term, viewpoints in expressing your private market exposure, that's an area of interest that we hear from clients and in our investment team that I think is becoming of more acute interest, is infrastructure exposure to support the real assets allocations that we have within real estate.
Got it. And if folks are, interested in finding out more about Cerity, or interested in, picking your brain a little more, how can they reach you?
You can find more information at CerityPartners.com, where you can find articles not only on our great investments, including private markets, but also estate planning, financial planning. We really aspire to be a full-service wealth management firm that serves the needs of any individual client, their families, also corporations and institutions as well.
Great. Well, Tom, thank you so much for answering my questions, and thank you so much for your time.
Thanks so much for having me on, David.
All right, David. So if people want to get in touch with you, if they have some more questions, how do they go about doing that?
Best way to reach, you can find me on LinkedIn. It's a good place to reach me, as well as wealthmanagement.com. The investment section is where all of our coverage lives, of not just private markets, but ETFs, SMAs, UMAs, anything that the top investment topics for advisors today.
All right. Well, thank you to all of you for joining us today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.